exam. But the practice exam kind of has all this stuff together with it. So with it for the chapter 16 investments. And just to give you guys kind of a heads up, when you go into the advanced accounting class, it's 414, I think it is. We have a thing called consolidations, and that's when you have more than 50% and you take the two companies and make consolidated financial statements. But they still use the equity method. The equity method is still used by a majority of people that do the consolidations. They still use the equity method. So this equity method is it's not really a one-off. You're gonna see it again in 414 if you're not already taking. Okay. Speaking of the equity method, 30% of the shares, they don't tell us anything else, so it's between the 20 and 50%. So this is going to be the equity method. Which is between 20. Well, truthfully, it's if you're influential. So the real test is if you're influential. If they don't give you that, then you go to the 20 to 50%. So they don't tell us whether they're influential or not, but we're going to assume that they are because we don't see anything that says they're not influential. Okay, so Cells Corporation. Wait, wrong. Monica taking significant. Oh, they did. Wait, I'm wrong. Significant influence. So they're influential. So, so it works on both of them. We have both of them. We have this, which right there you can stop. But then the second test is here, and it works for that one too. Okay. So this is double the equity method. Dividend. Okay, so they bought 30% of the 50,000 outstanding shares of common stock. All right, so how many shares did they buy? Oops. $15,000. 15,000 shares at $20 a share. And Mr. Calculator. $300,000. Should have been able to do that. Oops. Okay. So what's the journal entry going to be? Anyone?
We debit cash.
We're gonna actually, cash is actually gonna go down, so this will be a negative.
Or credit. So yeah, my bad. That's what I meant.
Yeah, so cash will be, asset going down. And what's gonna be on the other side?
Investment equity.
Yeah, we have investment, equities. And that's an asset going up. And one of the odd things about this method is that that investment account is going to be in all of these entries. Every single entry has this investment account in it. Okay, so those declared and paid a cash dividend of $40,000 to its shareholders. Now, we don't get all of that. We get 30% of it. I'll put that down here. So 40,000, we get 30% of it. We own 30% of the stock. Okay. $12,000. Okay, so this will be. All right, so what's the journal entry going to be for this? I'll give you the easy one. You guys can think of the hard one. So cash.
Cash debit and investment equity credit.
$12,000. I'm sorry. What was going to be the credit?
Dividend income.
Nope. Close. What?
Investment equity.
Yeah, that's a weird one on this. This is that, that weird thing where you own so much of it that you're really just taking it out of one asset and putting it in another. Yeah, and that's one of these, this is going to show up in all of them. At least once in all of them. They're not going to be the whole gym. Yeah, it's that weird thing that like I did before with the, I lost my, oh, there's mine. If I own both these, A and B, and if B pays A, of course, it doesn't make any difference. I'm no wealthier than I was before. B is worth less and A is worth more. Or I did that wrong. A is worth less and B is worth more. But so it's when you own so much of it that getting cash out simply is a reduction of your investment. But kind of a different way to think about it. What it basically means is that you own so much of it that it makes money the same way you make money, by making net income. Get this up a little bit closer here. Okay. Sales reported net income of 90,000. Okay, put that here. $7,000. Okay, so what are the journal entries gonna be?
You debit the investment equity and then credit investment income.
Yep, very good. So our investment equity. And if you think about it, they're making income, that's the same way we make money by making income, so. That's the way they do, and this will be. Investment income. And again, we have this account that shows up in every single one of them. So if you go through this and you don't have an investment account somewhere in one of these journal entries, you gotta look at it again. The one that is really kind of the confusing one for the most part is this one. You gotta, it's sort of like we're reducing this asset and increasing our cash asset. But we're no better or worse off than we were. Kind of like up here. We're no better or worse off. We gave up 300,000 in cash, we got $300,000 in investment. Kind of the same way down here, they gave back 12,000, okay, our investment is worth 12,000 less. Until they have net income, we're not gonna make any income out of this. Oh, what's the ending balance in it? Well. Started out with what, 300,000? We had dividends. And that reduced it by 12,000. And then we had income. And that increased it by 27,000. And by the way, if you look at this is subtracting dividends and adding income. This is the same thing as like your the statement of retained earnings. I put these so far out. Okay, so this will be our beginning, and I messed up my spacing again. Durr. And this will be our ending. $315. You want to check that? I think that's right. All right. Any questions on that thing? And again, it is a little bit wacky, but it's basically when you own so much of it that the only way it makes money is the same way you make money, by earning income. All right. Okay, I think I need to add something to this one. Okay, it said acquired 10% of the 500 shares of common stock. Let's make the assumption that this is the outstanding. Oh, it's not capital. Okay, so I'm gonna have to add this outstanding in there, and actually, the more I got a test are similar to this, so I got to do it to the test. I mean, it kind of indicates that they're outstanding, but just to be sure, there's no, I don't want confusion over that. Okay, the money are correctly classified as fair value. Okay, so they tell us that they are fair value. We don't have to worry about doing the calculations. And they have no other fair value securities. Okay. So. About 10% of them, so that would be 50,000 shares. $5 a share. $50,000. Okay. So what's gonna be the journal entry for that?
Investment equity and cash.
Yeah, this will probably be investment, fair value or just FV. Here, okay. And then our cash is going down. Okay. And June 8th. Martinez declared and paid 80,000 cash dividends to his shareholders. Okay, so we get what? 10%. Thousand. Okay, now. This is, we're not influential. This is just fair value. I'll do the easy part. You're actually going up by 8,000. And what's gonna go on the other side?
Dividend income?
Yes, good. Again, these are not equity investments. These are fair value investments. So we will pick up dividend income, just like it's the money falling from the sky for us. You know, in this case, because we don't have, we're not influential. It's not really our company, so to speak, that we don't have any influence over it. When they pay out money, we say, yay, that's income to us. Okay. On December 31st, the market price of Martinez Fashion was $8 per share. Okay, well, now notice we did not sell it on December 31st.
So we're gonna do the fair value adjustments and unrealized gain.
Yep. And yeah, so this will be unrealized gain. Yeah, it could also be unrealized loss if it was a loss. In this case, it's a gain, but whatever it is, it's gonna be unrealized. All right, so let's see. We have 50,000 shares at 5,000. Okay, so. I remember I did this before. Okay, so 50,000. Five. So, well, yeah, 250,000. No, wait, that's not the market value. Market value is 8. Is that crazy? What is 50,000? Maybe 400,000. And cost. I should say carry value. No. 50,000 times 5. If you do it at the carry value, you could also you wouldn't have to worry about what the adjustment is in the account. We're not going to worry about it right now. And this is it. Realized gain of 150. All right. Okay, so we're gonna unrealized gain of 150. Okay, so yeah, the fair value adjustment. And again, you can just put that in as FVA. Oops. And that is in asset going up. be an unrealized gain. Okay, now, this actually is kind of important here. Conchita has no other fair value securities, and the reason why this is important is for two reasons. First of all, if there's more than one security, you'd have to do a portfolio like we're gonna do later on. And also it tells you that the fair value adjustment was 0 at the beginning. So the fair value adjustment must have been 0 if this is if these are the only securities. You know, there wasn't anything in the fair value adjustment. These are the only stocks that they had. And so you don't have to worry about the portfolio thing, but also because these are the ones they had and they bought it on June 30th. Wait, is that right? No, they bought it on March 23rd, so there must not have been anything in the fair value adjustment account. And if there was, you would have done whatever it takes to make the fair value adjustment account come out to 150. Okay. Let's go to the third one. Believe it or not, this is the one that trips up more people than any of the other ones. And it's in the past, I put it on here as kind of like an easy one that everyone would get, and it ended up being just the opposite. And so this is one of the reasons why we're going over it. But this is just buying stock and then getting a dividend and then selling the stock. It's all realized stuff here. Okay. Yeah, 5,000 shares of common stock. $12 each. Fair value. Okay, we got everything we need for the first journal entry. And notice that they told us that the shares we acquired, we didn't have to go through any of the percentages of outstanding. We didn't have to do this thing. They just told us we got 5,000 shares. Okay, so 5,000 times 12, 60,000. Yeah. Okay, so this is just gonna be, what's it gonna be?
Investment, fair value.
Yep, good. You can just put FV if you want. For fair value. I'm gonna write it out. Just so that it's. And you don't need to put this in either, the asset thing. This is just me adding it on so people know why I'm debiting it or crediting. 60,000. And the easy part is we paid cash for it. Oops. Not so easy. 60,000. Okay, they paid 60 cents a share for the dividends. So let's see, that would be what? 5,000. $3,000. And what's the credit?
Dividend income.
Yeah, this is the fair value. We sold all the shares. Now, this is a realized gain, or is it a gain or loss? It's a gain. It's realized. They're actually selling it. It could be, the test could be realized gain or a loss, but in this case, it's realized gain. All right, so let's look at this. We have to take off the investment off the books. I'm gonna do it down here next. Okay, let's do this. So investment fair value. Asset going down. We paid 60,000 for it. How much cash do we get?
70,000.
Yep. So our cash we got. We sold all 5,000 shares. $14 equals 70,000. So this will be how much cash we got. And so what will this be? $10,000.
Gain on investment.
So gain on sale investment, yeah, this is a realized gain, this is. Hey, you put that in there if you want. You don't have to put this in, I'm just. Just to distinguish it from the unrealized gain, this has actually been sold. The thing has been sold, it's Oh, then what they would say is that the entire cycle of the asset has been completed. So gain on sale of investment. Probably should put that. Okay. And because this is realized, there's no fair value account either. Okay, and the last one on the test. Hey, I got a bug on my desk. I don't think I can show them to you guys. No, he left. All right, we have some a portfolio, and this is the way you'll see this most of the time. A lot of times companies will have more than just one investment. And what are you doing? $18,000. And this is 16,400. All right, this one's a little bit tricky. Because the fair value adjustment has a $300 debit, it has a gain on it of 300. Okay, so this is going to be well, it's unrealized. There's a gain or loss.
It's a loss of 2,000.
I got that weird 400 sitting in there. So it's gonna be what, 16?
Sorry, yeah.
No, I actually, I think on the exam, I think I remember eliminating, they're all thousands on the test, I believe. I'll have to look at it again to make sure I'm not lying to you, but I think so. It's just one of those things you put in and you go, why did I do that? So unrealized loss. Okay, now here's the problem though. There's already 300 sitting in that account as a debit. So apparently the previous year we had a $300 gain. So what do we have to do with this?
It'd have to be a fair value adjustment of 1,900 loss.
Yep. Oh, wait a minute, wait. I'm doing this wrong. And again, you just abbreviate that FVA. It's fine. This is an asset going down. And it's going to be, we have to get rid of 300 of the debit. And then go another 1,600 for the loss on top of it, so this would be 19. Hey, the bug's back. And so this will be an unrealized loss. In total of 1,900. If you think about it, you know, what did we do? We lost the 300 from last year, and then we lost another 1,600 on top of it. You know, we lost this, and then we lost another 1,600, so. Oops. So we lost a $300 gain, and then we lost another 1,600 on top of that. And so, and these will go on just from year to year. You'll go on and, you know, have the debit and the credit, whatever it is. If there's a debit in the account, that means it means it's a gain. If it's a credit in the account, that would mean it would have a loss in the account. And here's how this would look. Let me see if I can do this without messing it up. So fair value adjustment. Okay, so started out with 300 in the account. Then we so the ending balance on the account would be the 1,600 that we want in there. 1,900 minus the 300, this would leave a ending balance in that account of 1,600. So this is that loss that we have to recognize. Okay, so you know that is second here. Okay, so that is that fair value adjustment of 1,900. So this will be the ending balance of this will then be the 1,600 that we want it to be up here. You know, so when we actually show this account, it'll be, I'll look like this. Oops. What's that? 18,000. Um. And this will be the net investment, or it could be maybe a better way to say it is investment at market value. Which is what we want it to be. Question there? Okay. Well, let's take a break. We'll say be back at. 7:01. This is the end of this, isn't it? Yeah. Okay. We're gonna start a little bit on the accounting for income taxes. And basically, the first thing I'm gonna talk about is that the income taxes, taxable income is different than net income. And it's different for a number of reasons. I think I'm tipping over. For income, we're looking at, okay, how much income did this place make? You know, what was the actual income? Taxable income is a little bit different. There are things that go into the same thing that goes into the net income, but there's also other things. There are things, sometimes the government wants to encourage you to do something. For instance, one of the things we're going to find that they want you to do is to encourage people to buy equipment, you know, buy new assets, whatever they are. They encourage you to do that. Okay. So that's one of the differences between the government and us just trying to find normal net income, is that they'll actually have things that they'll encourage you to do. They also have things that they'll discourage you to do. Don't do this or we're going to penalize you. All right. So they have different kind of agendas. That taxable income is not really trying to find the true income. It's trying to, you know, get taxes, get revenue, but also trying to encourage certain things. So one of the things that they do that is very common is they allow for a faster depreciation of assets. So the government says, we want you to buy assets. Why do we want you to buy assets? Well, that, you know, buying assets keeps the economy going. It makes your business keep going, and it's reinvesting in your business. That employs people, and even and those people that you employ, we tax them too. So it's in our best interest to see that you keep the place going. So when it comes to you buying things, we allow you to depreciate it quicker. Now notice the difference between net income and taxable income. Net income, you want it to be high. Taxable income, you want it to be low. In fact, so low that if you can show a loss, you know, that's the ideal. So you know, your goals are kind of different. So they allow you to expense a lot of things that they want to encourage. One of those things is for buying equipment. And they do it in two ways. They have what they call an accelerated table, which will accelerate the amount you can depreciate. So you can depreciate a lot early on, cut your taxes down, right? A lot early on, which is a benefit. But then they also, a lot of times they'll shorten. So you may have something that maybe for GAAP purposes is a 7 or 8 year asset, but maybe for tax purposes, it's a 3 year. So the government says, no, you can write that thing off over 3 years. You a big write-off right up front for this, whatever it is. Now, and especially in this example we're going to go over first, for things like depreciation, it's a timing difference. It's a difference between, you know, expensing a lot early on and later on. Now, you want to expense it a lot early on. Keeping money in your pocket is always a good thing, but eventually those are going to reverse out. So they're timing differences. There's also some permanent differences, which we'll talk about later. But the first example we're going to talk about are timing differences, and hopefully kind of see how this, why we have this kind of difference between what we expense and what we actually pay the government. They're actually two different things because of this timing difference. It's sort of like having a payable, basically. Okay. So temporary tax difference example. All right, so we bought some equipment for 100,000. For GAAP purposes, we're going to have it for 5 years with no residual value. And for IRS purposes, it's going to be 3 years. And again, the government is being generous with us. They're saying, no, you can write that off over 3 years, show less taxes, pay less taxes for those, you know, the early on writing this thing down. You know, you can do it over a 3 year period. It's actually a little more, being a government agency, it's a little more complex than that. But anyway, So let's say that this is our example and that we have the same income every single year. And that the enacted tax rate, oh, that's not the color I wanted. The enacted tax rate is the same every single year. Okay, so this is our gap income. Every single year is 60,000. Every single year, the tax rate's 30%. Right, so this is very consistent for our for our purposes here. Okay, let's look at the depreciation calculations. All right, so this kind of goes to the differences we're going to have here. Now, when we came up with our income of 60,000, we had these for GAAP purposes, we had $100,000 piece of equipment, should be dollars. Divided by 5 years, $20,000 a year. Right? This is what we expect to do. Now, the IRS, they have kind of a wacky table. It's so wacky, I can't bold it. Making us bold those. And you'll notice that the table actually goes out, even though it's a 3-year, it goes out for 4. You might be wondering, well, why does a 3-year, why do we write down over 3 years, it goes out over 4? The government uses the modified accelerated depreciation tables. They use a double declining usually balance with what they call a half-year convention. Half-year convention means that you buy some equipment at the beginning of the year, you buy some equipment in the middle of the year, you buy some equipment at the end. On average, you buy the equipment halfway through the year. So there's a half-year convention. So you take half of the first half a year in year 1, then you get 2 full years, and then you take the last half a year in year 4, basically a calendar year 4. But so half year, full year, half year. That's how they come up with the 3 years. So a 3-year depreciation item, confusingly, is what they call a 3-year asset. It'll have 4 years of depreciation on the table. Which, by the way, if you're going into taxes, you love stuff like that because it's confusing. Okay, so when we come to our depreciation for taxes, our depreciation looks like this. They allow us to take 33 and about a third of the thing the first year. Second year, they let us take a whopping 44%, almost half the price of the thing in the second year. But then you start to run out of, 100% only lasts so far. And by the time you get to the 4th year, there's not much left. And by the time you get to the 5th year, it's absolutely down to 0. You don't get anything in the 5th year because it's completely depreciated down to 0. Okay, now look at this. This is one of the wacky things here. So look at this excess depreciation. So in the first year, they let us write off 13,000 more than we did for GAAP. The second year, they let us write off 24,000 more. Now we like this. We like this additional depreciation for paying taxes because it reduces our taxes. We love expenses. We love expenses and losses when we're doing taxes. I had a 3 flat in Chicago that I bought. In the first year, you put everything on the books, like what you estimate the cost of like the washing machine, the ovens, and the refrigerator, and all that kind of stuff. And I mean, the first year, I had an $11,000 loss. Yes, that was like $4,000 or $5,000, whatever it was. But the idea is, though, it was all this depreciation. I didn't pay out $11,000. It was this depreciation that they allowed for. Now, as time goes on, that runs out. But at least initially, it lets you. And again, the government's whole point on this is that they want you to invest in equipment, they want you to keep whatever it is you're doing, they want you to keep it going. And, but you know, having less income is what you want for taxes. So they're gonna let us write off 13,000 and 20,000. Now, you'll notice something though, we start to run out of stuff to depreciate. You know, we start to run out into the cost of the thing. For instance, by the time we get to the third year, we're writing off 20,000 for gap, but we're running out of stuff to write off for the IRS. It's only 14,000, so actually it starts to reverse out. And by the time we get to the end of this, you know, these will all reverse out to zero, basically. Okay. So coming down here, our income tax expense is based on our gap in depreciation. Oh, don't do that. Did there. Oh. So this is going to be our income tax expense. Why does it keep doing that? Okay. Now it's behaving. So this is based on our regular gap depreciation of 20,000. So we have our gap income of 160,000 times 30%. So we'll pay taxes every year of 48,000. This will be our income tax expense. This is how much income we're showing for gap. This is our tax rate. This is what we're showing as our expense. Now, we're not going to be paying that into the government, because we're going to take our gap income. I should probably make that into certain colors. I'll make it red. I guess. We're going to take that same gap income and say, well, okay, well, now we have this excess depreciation from up here. So we're going to write off 13,000 more of depreciation. So our taxable income drops down. And we'll end up with income taxes payable . Notice there's a difference here. Our income tax expense is for 48,000. Our income taxes payable is only 44,100. So we have a deferred tax liability change of this. We go to the second year, same thing. We have taxable income or income tax expense of 48,000. This is only 40,000. We get another 735,000. So now our deferred tax liability total is up to 11,000. You know, okay, it starts to reverse out in year 3, year 4, even more. And by the time we get to year 5, it's completely reversed. So this is what we're going to be doing for our taxes. We have our income tax expense and the difference between our income tax payable. We're going to have these deferred, what they call deferred tax liabilities. We're really not getting out of paying them. You know, you're really not getting out of paying this by the deferred tax liability. Eventually it's going to reverse out. You know, first year you're going to owe 399, next year you're going to owe 11,000, whatever, 9,000, and as time goes on, And if you look up here, you can kind of see that. Look at, by the time you get to year 3, we're showing tax expense of 48,000, but we have to write a check for 49,000. And eventually we start paying down that liability. And it is a liability, paying down. So, for my example, when I bought the building, you know, first year, hey, well, you know, as time goes on, you know, and first of all, you know, rent's coming in and all this kind of stuff. Eventually, you know, that reverses out fairly quickly because most of that stuff is 3-year property, washing machines and refrigerators and all that kind of stuff. Those are all 3-year properties. So by the time you get to the 4th year, you're paying off. You're right back where you started from. You know, but initially it saves you money. And again, the government's idea in doing this isn't to show fairly what your income is. They want you to buy stuff. They want you to buy whatever it is, and to encourage that. All right, I think. Well, you know, let's just stop here. We'll stop here because I don't want you guys got a test you got to get in. It's really early, but makes up for all those times I kept you too. So we'll stop there, but we'll go through these next classes. They're not too hard. We should be able to finish this by next class, I think. Let me look at it just to make sure. Yeah, we'll be able to finish this next class. So go ahead and you guys can't see what I'm doing. All right, so stop here. And we'll finish this next class. But again, this is kind of the idea behind it. It's a timing, temporary differences are timing differences. So things like depreciation is a timing difference. Okay, well, so I will be sending out a test. I'm gonna go through the test and check them to make sure. I want to put that outstanding into the second problem, just so there's no confusion on it. And then and just check it out, make sure there's nothing else stupid on the test. But anyway, yeah, so I will I'll send that out to you guys. You probably get that in about within an hour, I would say. The chapter 16 exam, and there is a drop for it. Say, check just to make sure I put it in. I think I did, but that's not. Yep. Okay. All right, so look for the test. It should be in your mailbox in about within an hour, and then it's due not this Friday, but the following Friday. Any questions? Okay. Have a good evening.
Thanks, Professor. Have a good night.
Thanks, guys.